We all like the idea of earning a regular income while holding on to the stock, which in the meantime also rises in value. We like passive income generated from dividend stocks, a sense of security it provides. Yep, I'm talking about dividend investing. Hello everyone, I'm Rakshit Pai, and in this video, I'll explain how to select stocks for dividend investing. Dividend investing, just like any other investing strategy, has its own approach. When choosing a company, there are some factors we can't give up on, and this is very important in case of dividend investing. If you are someone who cannot dedicate the hours required to do research on stocks, don't worry, invest like a genius with ET Money Genius. It's a membership program where you will get personalized investment plan. More about it at the end of this video. What is dividend investing? As the word suggests, investing for the sake of earning dividend income is called dividend investing. But that's not it. A dividend is just a passive income, a side source of income. It is a pickle in the dish and never the main course. So what dividend signifies is that the company paying steady dividend is number 1, consistent and growing revenue, number 2, profitable business, number 3, cash rich business, and number 4, most importantly, the business has enough money to spare such that they give it out to its shareholders as a gesture of gratitude for being with them throughout the period they hold on to the shares of the company. I have written in detail about this topic. Do check the link in the description for more information. Factors to consider before investing in dividend paying stocks. I listed out 3 such factors that you must check for sure before investing in any company for the sake of dividend. Number 1, cash position. Guys, listen to this and listen very carefully. There are a number of ways in which the management can deceive you by paying you hefty dividend and trapping you into holding on to the shares at a loss. Don't ever invest in a company without knowing their cash position. Every company must and should have healthy cash position. Just go through the company's balance sheet to find out more. For instance, if you calculate the operating cash flow of a business, you will know the amount of money made by its core business activities. The operating cash flow is nothing but net cash flow from operations divided by the company's current liabilities. This ratio has to be over 1. Now you tell me, if the company is unable to fund its current liabilities, such as short-term debts, how can you expect them to pay you dividend? Number 2, business type. We are aware that each industry has its own demands for cash. Some are very high, some moderate, and some low. For example, capital-intensive businesses like textile, transportation, and logistics, they burn cash like a steam engine does to coal. And then there are businesses such as IT, finance, insurance, etc. who require cash for day-to-day operations but are always left with ample cash in the bank. So much so that they go out and invest their money. These are the sectors you must look into. A tip I would give is that if a company's product or service is well known among the general public, it has monopolistic market share and is selling its product and service at a beautiful double-digit margin, you can expect a fat dividend. Well, maybe not a fat dividend, but a consistent one. Number 3, metrics. Before buying dividend paying stocks, we must evaluate them, right? So in order to evaluate, you must use the following metrics. Number 1, dividend yield. If you buy a stock worth rupees 100 and the company pays a dividend of rupees 10 per share, then your dividend yield is 10%. To calculate, simply divide the annual dividend earnings by its current market price. Number 2, dividend payout. If a company earns rupees 100 crore in net income and pays out 30 crore to its shareholders as dividend, then the dividend payout is 30%. We don't want our company to pay everything they earn, right? So with this, you will know what amount is kept as reserves and what is distributed. Number 3, earnings growth. If earnings are not growing, then your dividend will also stop growing, or in the worst case, it may stop altogether. 2 ratios to help you out here. Number 1, Price to earnings growth rate. The PEG ratio is a way to figure out how much a stock is worth by comparing its price to earnings per share and the growth prospects of the business it represents. You know PE ratio, right? For PEG, you must divide the PE ratio by its earning per share growth rate. And the second one we have to check is dividend payout growth. It is the percentage of stock dividends over a period. To calculate the dividend payout growth rate, divide the current dividend per share by the previous year's dividend minus 1 into 100. Since you have watched till the end of this video, here's a list of top 10 worth investing dividend paying companies. These are not just a good dividend payers but are also consistent compounders. Yes, they are well established, financially sound companies. Britannia Industries, ITC Limited, Supreme Industries, VST Industries, ICICI Securities Limited, Infosys, HCL Technologies, Marico, Hawkins Cookers Limited, Heidelberg Cement. Do your research before owning the mentioned stocks. And now let's see what ET Money Genius is all about. Making money in the stock market isn't easy, right? That's when I realized that in order to earn better returns, instead of running behind top mutual funds, why not try ET Money Genius? ET Money Genius will understand your risk profile and suggest various mutual funds where you can invest. For instance, you can invest in a mix of index funds of large, mid-sized and even small cap companies. Why not try international equity, and even debt instruments and gold funds are offered. Basically, you get a very well diversified portfolio. Not only that, ET Money Genius will also make timely adjustments to your portfolio such that your portfolio returns are not affected by changes in the market. So what are the expected returns? Well, if you had invested as per ET Money Genius high growth mutual fund strategy for any 7 years in the last 15 years, you would have earned 16.1 CAGR returns. The way it ends here, because with no additional work, you can earn a wonderful return just by subscribing to ET Money Genius membership. Check the link in the description. Hope the video is helpful. Thank you for watching.